Hello, my name is John Cash. I am the CEO of UrEnergy. I'm sitting here today in Casper, Wyoming. It's a beautiful day here, a great day to be a uranium miner. At UrEnergy, we have two flagship properties. Lost Creek has been in production now for over 9 years. We have got great production there where we've made a decision to ramp production back up, and that's coming along very well in Header House 2-4. Our next production area, Header House 2-5, is well under construction, and we'll be bringing it online in the coming weeks. We've already produced nearly 3 million pounds at Lost Creek. Our second flagship property is called Shirley Basin. It is also in Wyoming and an in situ project. It has all the permits in place for that. We are waiting to layer in additional sales contracts to justify bringing it online. So that's a bit of an update as to where we are as a company.
John, thank you very much for the introduction. Very nice to meet you. My goodness, it's been a pretty action-packed year so far. You've got a contract with the DOE to sell uranium at 64 and a bit dollars per pound. You've raised $40 million, and I think in one of your news releases you talk about achieving commercial production or a commercial restart of Lost Creek in May 2023. So can we just kind of talk about that commercial restart and kind of just go into a little bit more depth on where you are with that project, please?
Yeah, right. And really what precipitated that decision is we've been able to sign up 2 really good long-term contracts that are profitable on an all-in basis. And so that was really the reason we said, hey, it's time to go back into production. We've got those really good base revenues locked in. They represent about 50% of our licensed and constructed capacity at Lost Creek. So we reported to the public we're going to go back into production to fill those contracts. So just a few weeks ago, we were able to bring Header House 2-4 online. That is the next production zone within Mine Unit 2. We have a total of 12 mine units that we have identified at Lost Creek. So Header House 2-4, the 2 stands for Mine Unit 2. The 4 stands for it is the 4th header house or production area within that Mine Unit 2. So it's up and running now. We've got very good flows. We're beginning to see some breakthrough in the recovery rates there. We have a ways to go on that startup, but so far things are looking pretty good, and we're excited about that.
Can I just...
Oh, please.
Just jumping in on that. So just to repeat the kind of the bleeding obvious, for someone like me or for a new viewer, this is in situ recovery of uranium. So you have a pump which you've put down fluids in one well and you draw it out of another well. And what you're trying to do is get the fluids to flow across the geology and leach the uranium and then to come up in the recovery well. Can you just kind of give me an indication of when you talk about a Mine Unit 2, how much do you know about it? I mean, because you've produced 3 million pounds from this area before, or from this mine before. Has production come from this mine unit, or are you drawing on experience learned from a different mine unit?
Yeah, so Mine Unit 1, which we've already produced from, is adjacent to it. It had 13 header houses in it, and we've extracted the majority of the mineralization from that. We do have some pattern areas we can go back into and get some additional recovery there, and so we intend to go back to certain areas of Mine Unit 1 later on. So Mine Unit 2 is immediately adjacent to the west, and so we plan on having around 12 or 13 header houses, production areas within Mine Unit 2. Each header house will have around 60 pattern areas in it, with production wells and injection wells. And as you stated, this is a in-situ mine, so we can bring it into production relatively quickly because we don't need to, build an open pit or dig adits. All we need to do is install wells. So we were able to bring it online very quickly.
And just for my benefit, what is a header house?
Yeah, a header house is nothing more than a small building that has 2 manifolds in it. One manifold serves the injection wells, and on the other side of the house, there is a manifold that serves the production wells. So all the production wells will come into that production manifold. All the injection wells will be served by that injection manifold. It's really nothing more than a building that collects the water from the wells or distributes the water to the wells, and we use it as a metering point. So we measure the flow to each well and the pressure to each well.
And thank you. And you used the term breakthrough. So when you kind of restarted in May, what's the distance between your injector well and your kind of recovery well? And when you talk about breakthrough, is it that you can kind of trace fluid starting off in the rock mass here, and then you can pick it up in the rock mass later? Is that what you mean by breakthrough?
Yeah, that is. And we use what's called a 5-spot pattern. So it looks like the 5 on a die. On the corners of that square, that's a 100-foot square, those are injection wells. And in the center, we have a production well. So the distance, the triangular distance from the injection well to the production well is around 73 feet. So when we start injecting chemicals on the corners, it takes a while for that to percolate through the ore body and get to the production well. And what will happen is when you start to see the chemistry come through, you'll see a slow trend for a few days of that uranium coming through. And then as you overcome the chemistry in the ground, the reduced chemistry with your oxidation, you'll begin to see that peak very quickly after a few days of breakthrough. It'll peak very quickly and then begin to come down and then become asymptotic with the axis of that curve. So we're at the early stages of that, and we'll see how things develop over the coming weeks. And
when you talk about your long-term plan or your plan to kind of start up another header house 5, sorry if I got the header house 3. Sorry, what's the nomenclature? Okay, because it's in the mine unit area 2 and it's the header house 5. Got it. Is that going to have a step change on your production? I mean, how many of your production patterns are you going to have around header house 2 4?
Yeah, we'll have around 60 pattern areas there, and header house 5 will also have around 60 pattern areas. That's pretty typical for how we manage things out at Lost Creek. That fits into the header house very well, and it's a good geographic distribution.
And where are you in terms of kind of laying out that 60 well pattern for header house 4?
So they are 100% installed and online. Header house 5, they're all installed. We're working on plumbing them into the header house right now, and within just a few weeks, we will turn those on as well. That will effectively, we hope, that will effectively double the flow because that'll have 2 new header houses online. So that'll effectively double production.
And what will that give you in terms of kind of a stable production rate in terms of pounds of uranium on a quarterly or an annual basis?
That's a good question for our geologists, but typically we're going to have anywhere from 120 to 180,000 pounds under each header house being addressed. And we're looking at 90% recovery from each of those. So at 90%, that's a great recovery rate, but that's what we've experienced on average at Lost Creek over the past 9 years. That's exceptional and really setting the standard for the industry. We hope we can get back to those recovery levels again going forward. So, but yeah, we like to see 120 to 180,000 pounds per header house.
And when do you expect to kind of reach steady state on that? When are investors going to say, oh, they've hit their run rate?
Yeah, so it's going to take us several months to ramp up to the production rate we want. We could go faster, but we only need to produce 180,000 pounds this year to fill our contract. So we're not in a race right now to maximize production. We are simply trying to get that 180,000 pounds produced this calendar year to fill our contract book. By the end of this year, though, we would like to be at a rate where we can produce 600,000 pounds per year or a little more than that, because our contract book jumps up to 600,000 pounds next year. Now, we're trying to layer in additional sales contracts as the price goes up. We want to layer those in a rising market, so we're working on that. If we're successful, we'll want to bring on additional production to fill those contracts.
Because the 600,000 pounds of contracted production that you've kind of or contracted production that you've contracted out is only half of your total capacity. So you could go to, on this facility, you could go to 1.2 million pounds per annum, and if you can get other contracts, you'll expand to fill into that space.
Yeah, that's exactly right. Yeah, 1.2 million pound licensed and constructed capacity at Lost Creek, of which we've only contracted 600,000 pounds, so 50%. Beyond that, we have Shirley Basin, which would be our next project, fully permitted, construction ready, and it's licensed at 1 million pounds per year from the mine. So from a mining perspective, we can take operations up to 2.2 million pounds per year once we construct at Shirley Basin.
Okay, I'm just going to stick with Lost Creek for a second. I think in one of your presentations, I've seen that you showed the historic production and the historic costs, and they varied year by year between $16 a pound, I think, was the lowest, and 24 was the highest, or 23 and change was the highest. Kind of around the $20 per pound kind of cost of production. Is that something that you expect to see going forward, or has inflation come through? Are reagents more expensive? Is labour more expensive? Can you give any guidance on your cost profile going forwards?
Yeah, Lost Creek is a very low-cost producer. We've had great success there over the years, and you're spot on. There is a range of costs that we've seen. What you'll also see, though, is the more we produce, the cheaper it gets, because there are real economies of scale. And so our objective here is not to stay at low production. We want to increase that production rate, because that, honestly, it maximizes our profits. So inflation is real. Make no mistake, virtually everything is more expensive. Virtually everything is a little bit harder to get these days because of supply chain problems. And so we are experiencing that. Are we going to get back down to a $16 a pound C1 cash cost? No. It's probably going to be $2, $3, $4 a pound higher than that. Likewise, the all-in mine site, historically, we've been able to get down to nearly $33 a pound. Are we going to get back to that? No. It's probably going to be $36, $37, $38 a pound because of inflation. It is real, and we do feel the impact of that. But nonetheless, we believe it's going to be a very low-cost producer. We actually put out an analysis of that in September of last year that's linked on our website. So if the viewers want to do a deep dive on the economics and the geology, the engineering, the technical, that report is available to the public.
Thank you. And of course, if you're producing 1.2 million ounces, 1.2 million pounds per annum, that's the gold geologist in me coming out. If you're producing 1.2 million pounds per annum, your unit, the charge to your fixed cost is half of what it would be if you were producing at 600,000 pounds per annum.
Yeah, that's exactly right.
Yeah, good. Great. And when it comes to looking at let's just sticking with Lost Creek for a moment, just in terms of the Capex committed. I mean, because you've got the installed capacity, and because you've effectively got all the plumbing already put in for header house 2-5, does that mean that your Capex commitment to Lost Creek is relatively small, if at all?
Yeah, right now the capital expenditure is negligible. All of that is being expensed as operations going forward. The roads are already there. The power lines are there. We have to do a very short stub off the main power line, but we're talking about, the cup 200, 300, 400 feet off the main line into each header house. So that's negligible. So really what we're looking at going forward is operational expenses. And because the capital's been spent, the plant's there, the pipelines are there, all of that's been sunk already.
Good. Let's move on to Shirley Basin. What are we looking at in terms of timelines and critical paths and capital?
Yeah. So I love Shirley Basin. It's a great project. It has a lot going for it. 8.8 million pounds, good grade, not the biggest project in the world. But the reason we made acquisition on it is because those are quality pounds, and we believe the cost of production is going to be actually slightly lower than at Lost Creek. Shallow pounds, the roads are there, power lines are there. We have 2 nice buildings. There's a waste disposal cell that we can rely on. All the drilling is done as far as exploration and delineation. So
it's another ISR project.
Another ISR project. We have all the data we need to go in and install patterns right now. All the patterns are planned. The locations of the header houses are planned. Permitting is done. And so we can move over there quickly. The go decision will be predicated on contracting. So as we layer in more contracts and we reach the end of capacity at Lost Creek, that will be our decision point to go ahead and go over to Shirley Basin, build out there and ramp up production. So as far as capital costs go there, we had been saying around $30 million to build out the plant and the first several header houses to ramp up to commercial production. Inflation is real. I'm going to hedge a little bit and say probably now more like $35 million to build that out. Timing, the facility itself, we're looking at just a satellite, which is a relatively small building. And so we can build it out very quickly, probably within 6 to 8 months. But then if you throw in the time to ramp up, we're probably looking at 18 to 24 months to build out the plant and the mine and ramp it up to commercial production. And by commercial production, I mean at least several 100,000 pounds a year rate. So we can do it fairly quickly, and we can do it at pretty minimal cash cost.
Capital cost and cash cost.
Yes, capital. Thank you.
So yeah, from go to woe, from that kind of decision point, you're looking at kind of a couple of years to do everything, kind of build it out, source all the material, build the header houses, get the plant, the centralized plant built, all of the plumbing infrastructure in, plus those breakthrough injections. You've presumably you've done the test wells, you've done pilot tests already there, have you?
Yeah, we've done hydrologic tests. We've also done benchtop tests on chemistry to make sure that your body is amenable to an alkaline leach, and we had very good recovery rates during that testing. Shirley Basin is well known for its extremely high flow rates. It's a very porous fluvial sandstone, so we believe we're going to get exceptional flow rates there and good recovery. So those things have been tested.
Good. And have you done kind of final front-end engineering design? I mean, do you have to kind of go through the detailed engineering once you have that kind of the contract decision, or is it already done?
So to a large degree, we're going to utilize the engineering from Lost Creek because we've already engineered the ion exchange portion, and that's really all we're going to build at Shirley Basin is the ion exchange portion. So we're going to rely heavily on the engineering that's already been done there. But right now we are embarking on detailed engineering. We're especially interested in the electricity, motor control centers, and transformers. That's going to be one of our priorities to specify those so we can make a decision of whether or not to go ahead and purchase them, because those are very long lead items. We want to go ahead and get them on the shelf, so to speak, so that when we do pull the trigger and decide to go into construction, we've got those ready to go and we can build out very quickly and be responsive to the market. We don't want to get behind the market where the market takes off and we can't bid into it, whether that be spot or long-term contracts, because we're waiting on parts. We don't want to get in that situation. So we're well aware of supply chain issues, and some of our engineering right now is really designed to get ahead of those issues. How
much is it? What's the capex of those kind of that electronic switching, those elements that you were talking about?
Yeah, I don't have a cost for you, but it's going to be in the large six figures to be able to do that. Maybe getting into the low millions. That's a significant component of the cost.
Thank you. That's really clear. That brings us basically to the market, because if you're waiting on contracts, not if that is the critical element in a go decision, how are you seeing the markets at the moment, notwithstanding perhaps a bit of summer slowdown already?
Yeah, we are seeing a bit of a summer slowdown. I think that's going to be relatively short-lived because we're seeing that there's the potential to bring a lot more pressure onto the spot market with some of the funds that have been set up to buy physical pounds. URE, Kazakhstan also was looking at funding a program to buy physical pounds. Of course, Sprott, which really is one of the bigger players in the space. So we believe that as we go through summer, maybe coming into fall, we're going to see a lot more pressure on that spot market. Our sense of of matters is, and what we're hearing from our internal analysis, is that there are not a lot of pounds out there that are mobile. And so as we see more pressure on those and those are taken off the market, we expect to see the spot price go up potentially fairly significantly before the end of the year. Now, we don't typically sell into the spot. So I want to make that clear. We typically sell pretty much exclusively into the long-term contracts. We have discussions with utilities very regularly, European and U.S. utilities, and there's a growing interest in buying secure pounds.
I was going to ask about the nature of your natural audience is the US. I would have thought that your natural audience are the US utilities, but it's interesting that you're also speaking to the Europeans. And do you have any conversation with the Japanese?
We talk to people across the board. So yes, we'll talk to any ally, whether that's an Asian company or European or North American, doesn't matter. But you are correct. Our natural audience would be more in the U.S., but there are buyers around the world that are interested in securing supply and in diversity. So I think those conversations that we're having globally are becoming more interesting as geopolitics kind of mandate that. Russian supply is in question. U.S. Congress may cut that off later this year. And I would say that the Kazakh production also is in question, not for technical reasons, but just for geopolitics. In contracting, it looks like a large percentage of those pounds coming out of Kazakhstan are now headed to China or to Russia. And the supply that's available to the Western world is declining. And of course, Kazakhstan, they are the biggest producer in the world. They generate about 46% of the world's yellow cake. So when that supply is absorbed by other countries, it calls into question where the West is going to get their pounds. So I think utilities and other fuel buyers, that they're aware of that. And so we're having more sincere discussions from potential buyers.
Good. Well, I look forward to seeing that. I mean, it's one of those things I can't press you too much about because you've got confidentiality responsibilities, and in a sense, it will only come out when it comes out. Yeah, I mean, that's just monitoring the market, really, isn't it? Just to see how frequently people talk about getting contracts signed and utilities are active. But apart from that, there's not much that we can look at in terms of preempting. We've just got to basically take a view that it's going to happen.
Yeah. It is interesting. There certainly is a bifurcated market right now. Unfortunately, that price is not published by UX or Trade Tech or others. They typically look at the global price. But there is a bifurcated market. And if you're in a safe jurisdiction with proven production, you are able to bring down contracts at a significantly higher price than what's published. And we've been the benefactor of that. I think we'll continue to be the benefactor of that, especially as things continue to heat up on the geopolitics and supply chain issues. For technical reasons, geopolitics, contracting reasons, things are changing very rapidly. And I think as we move into fall, we're going to continue to see price escalation, not only on the spot, but on the long term, but also on Western production.
And do you think that bifurcation is kind of well represented by the difference between the spot, which is kind of around $56 a pound, and the deal that you got with the DOE at 64 and a bit?
Yeah. So the deal with the Department of Energy, we've already sold those pounds to them, so got a great price, a little over $64 a pound. I can't talk too much about what our specific contracts are or who they're with, but certainly getting into the upper 50s and into the 60s, that's very obtainable right now, and I think is reflective of the bifurcated market. So we'll be putting out more on that. A little bit of that can be deciphered from some of our press releases. We've already said that this calendar year that our revenue will be around $17 million. Going forward, the contract book for the next 6 years, we're looking at about $205 million for that 600,000 pounds per year. So you can start doing some math and deciphering what the price is. But we've got some great pricing, and we think that's going to continue to rise going forward.
Thank you. Now, as an external observer, how do you feel that a company like UrEnergy should be valued? I mean, of course, most CEOs will say that their share is undervalued and there's a fantastic buying opportunity. But on what basis do you think that investors should kind of value these kinds of companies?
Yeah, no, great question. We like to keep our story very clean. We're not encumbered by large reclamation liabilities. We're not encumbered by large royalties. We just have clean projects, clean, well-run company. So I think I need to point that out because that does set us apart from a number of our peers who have large liabilities, who have significant technical challenges. So we've got just a good, solid project there at Lost Creek, and we believe we're going to have a good, solid project at Shirley Basin. So that should be kept in mind, and there should be a premium put on UrEnergy for those reasons, because it is a very clean story. But when you go look at the numbers, a good way to value us is look at capacities that are built out. You need to give value for the permitting that's in place. You need to give value for the infrastructure that's already in place. That is real value versus a company that may have a resource in the ground, but they don't have their licenses. They don't have anything constructed. They may not even have a social license. And so value has got to be given there. And then you have to begin to recognize the value of production, the contracts going forward, the pounds in the ground. So all of those things need to play into the equation when you're going to calculate a value. Again, I'll refer the watchers to our September report. If you want to look at an NPV calculation for Lost Creek and for Shirley Basin, that's there. But the company is worth more than that because we have tremendous exploration potential, and we also have the value of the licenses, the value of our expertise and team that's been assembled. So all of those things need to be looked at when assessing the value of UrEnergy.
Thank you for the take on how to look at the value of the company. I guess then it comes down to taking a view whether you're kind of trading at a premium or a discount to NPV, and then one starts when production begins to stabilize out, then you can start to look at cash flow multiples and leverage to the uranium price. Good. I will look into that and kind of get my old analyst's hat back on. John, thank you very much for the interview. I really feel as if I've learned a lot about the company in a short space of time. Could you just, to kind of wrap up, talk me through the second half of the year, what you're looking to deliver and what the market should look out for, and kind of key milestones or goals that you're looking to achieve?
Yeah, some of our goals, or maybe another way to look at it would be catalyst for the company, is number one, continuing to ramp up production from Header House 2.4, 2.5, 2.6, going through the rest of this year. So watch for news on those as we ramp those up. Also look for additional information on contracting. We would love to be able to continue to contract in as the price moves upward, continue to layer in good, profitable contracts. And then also, I think the third thing to really be watching for is M&A activity. We've not been shy about saying that we are interested in making acquisition of quality projects. We want to be careful to keep our story clean. We're well recognized for having a very clean, technically strong story. And so we're going to be very disciplined on the M&A front. But nonetheless, we would like to grow the company larger for a variety of reasons. But one of those is the economies of scale that we talked about. In the next 5 years, we would love to be at a production rate of 2 to 4 million pounds per year. But that can only be done if you can acquire the right assets that are economic. So we're looking hard at that, looking for opportunities to grow our production internally and externally. So those are really the catalyst over the next 6 months.
Good. And thank you. Just a final question in terms of your kind of balance sheet. You've got enough capacity to do the Shirley Basin expansion. When might Lost Creek be cash neutral or even cash flow positive?
Yeah, so this year we won't be cash flow positive because we're trying to get up speed and get into production. But as we go into next year and we start filling those contracts, 600,000 pounds a year, we believe we're going to be cash flow positive. But you're absolutely right. Today we've got plenty of money to build out Shirley Basin. We've got a great, strong cash position. Last quarterly report in April, we had $73 million in cash. Beyond that, we've got 250,000 pounds of inventory that we can convert into cash if and when we decide to. So from a cash position, we are very well positioned.
Good. John, thank you very much. Look forward to the next one.
All right. Thank you, Merlin.